Hi everyone, and I welcome you all for this call on India consumption story. And today would be a great time to talk about this for multiple reasons. But if you look at India's consumption theme, India has one of the largest and youngest consumer base in the world, and consumption story is one of the most strongest story in the wealth creation journey of India. It has been one of the strongest story, and it will be one of the strongest story in decades to come. To talk more about this, we have our CIO, Trideep Bhattacharya, with us today. He's looking very happy and smiling. Definitely, there is some good news for all of us in this budget and maybe for this theme as well. So let's figure this out. So welcome, Trideep.
Thank you very much, Niranjan, and smiling as always.
Thanks. So let's start with the market, Pradeep. What's your outlook in market for 2025? Which sectors are you bullish on? And especially, if a lot of our readers and viewers would have read our outlook, you have talked about consumption being the dark horse of 2025. You had said IT would be the dark horse of 2024, which kind of played out really well. And this year you have said consumption. So your thoughts on this?
Thanks, Niranjan. And we have been saying for the last few months that earnings outlook for the country has actually kind of suffered. If you look at it from FY25 onwards, broadly speaking, across major indices, we have seen earnings cut of about 10-12%. And if you actually look at the market correction, it's kind of broadly mirroring the same. So we can't say that the market correction is unfair. In fact, it's in sync with what earnings cut has been. And my thorough belief has been and continues to be that markets are the slave of earnings. So if earnings are not coming through, markets will ultimately languish. And that's what we have seen. And we've been talking about this. Our idea in terms of our portfolio positioning, as you know, Niranjan, is positioned around areas of earnings resilience. Good times or bad times, we want to orient ourselves towards those sectors or areas where we have either a country-specific tailwind, a regulatory tailwind, or a sector-specific tailwind. And keeping that in mind, over the year and a half, we have been talking positively and towards manufacturing, real estate, IT, and NBFCs within financials. And in that context, as you rightly said, last year we went, beginning of this year, beginning of the year, beginning of calendar year 24, to remove the confusion, we went from underweight to overweight IT. And we called out IT being the dark horse of calendar year 24, which is the last year. And the idea was that the earnings were bouncing around the bottom and valuations were reasonable. This time around, in the similar breath, once I was looking through the financials, it occurred to me that consumption seems to be in the same place. And that's the reason we called out consumption to be the dark horse of calendar year 25. While it's a term being used, dark horse, what we are trying to communicate is that the beginning of the year is likely to be soft, as you could see in the result season that is ensuing right now, and maybe to a certain extent in the March quarter. But I think as we go on to FY26, things will likely improve. That's really the connotation, what we meant by calling it a dark horse of calendar year 25. And reflecting the same, if you look at in our diversified funds, we have been underweight consumption for a good while now, for better part of Modi 2.0. But as we move forward, we gradually have been increasing our weight in consumption. So we would be overall, from a consumption standpoint, around about neutral. So in many ways, we are going from underweight to overweight in this transition. And hence, we called out consumption to be the dark horse of calendar year 25. And overall, we feel that, as the year goes by, and I have my reasons why that is the case overall, we think that things might actually improve and will be good for investors overall. So that's the thinking. Those are the sectors that we are positive on, and that's the reason why we call consumption to be the dark horse of 25.
Thanks. Trideep, let's come to budget. Since budget, that is, since Saturday, I think so everywhere we are seeing this budget has been a consumption-focused budget. In fact, when our Prime Minister, Mr. Modi, uh, was talking about this budget, he mentioned a line that this in budget will be uh, a budget where investments and consumption will increase. Uh, what is this, all about, and why it is that people are talking that it's a consumption-driven budget? It will drive consumption.
Indeed. So I think starting with the background of calling it a dark horse, of course, we didn't have any clue about the budget, but it turned out to be a shot in the arm in the sense that overall, if you kind of keep the emotions aside and just look at the pure numbers, essentially what's happening is about 1 lakh crore or about 0.3% of GDP is being set aside for consumption. And I think you had a slide regarding the same overall in that context. Yeah, that's the one. So roughly about 0.3% of GDP or 1 lakh crore being set out for the consumption of the sector. Now, what that means is for urban middle class, this leads to a salary increase, effectively take-home salary increase of somewhere between 2 to 7%. And that's the reason, along with everyone, all of us are in slightly cheerful mood than what we were before. And I'm sure it spells good news for the middle class urban consumer, which has been kind of languishing for the good year or so. Something that you pointed out on the right-hand side, and they would actually start to see the benefit overall. The second aspect, which also came about in the budget, and I would actually combine with what's happening in the economy as well, starting with last year monsoons. Last year monsoons have been pretty good. Subsequently, rural cash flows improved. As we are going through the current harvest season, sowing has been pretty robust. So hopefully the rural cash flows improve, and that will result in consumption spending, hopefully in FY26. And that's the second tailwind for consumption. And also in the budget, they provided some SOPs for the rural economy as well. Hopefully that boosts the rural consumption. And finally, one of the drivers that we have been talking about in the context of consumption is the easy access to credit. And certainly this budget kind of, with customized credit cards, as you've highlighted here, would lead to, easier access to credit overall. All of these as a package, kind of, if you ask me, would have a meaningful multiplier over the next couple of years as they get spent. And hopefully, kind of, it kickstarts the consumption side of the economy, which has been lagging, if you ask me, over the last couple of years. And you've rightfully put the sectors that benefit. But more importantly, this budget, if I may say that way, it was a bit of I can't say change of heart, but it was the right balance. Modi 1.0 and Modi 2.0, it was all about CapEx, CapEx, and CapEx. I think somewhere, probably the Honorable Finance Minister and the central government realized that that CapEx spending should peak around 3.1 to 3.2% of GDP. Is just about fine for the economy. So it's not that CapEx is not growing. CapEx is growing at about 10%, which is meaningful of India's base. And this is after we have seen a good 30-40% growth on a CAGR basis over the last 3-4 years. But incrementally, the consumption is what kind of, the orientation is towards, and hopefully kind of that benefit. So in a nutshell, the budget boosts our case for consumption that we were talking about, maybe not all that a dark horse any longer.
As we were discussing, you said, and I may ask you that, is this the only horse now, or I'm sure there other sectors also would do well, right?
I'm sure. I think, as I said, that consumption, that, I think, industrials, it's not that it's going to go away, or manufacturing, but it is just that there was a bit of a hype, there was a bit of a kind of valuation excess, if I may call it that way, which was gradually getting built in that sector, which I think will normalize, give it a few months. And then the twin engines of growth, both industrials as well as consumption, would actually kick in order, if you ask me, as we get to FY26. And something else that I talked about in my kind of, year-end commentary, where I said that FY25 would be the lost year of earnings. and broadly it's kind of heading that direction, which is practically low single-digit growth. FY26 could be the year of rebound, earnings rebound, driven by consumption as well as held up by industrials, is the way I would put it.
Thanks, Trideep. So while we understand that, the budget has been, you know, more consumption focused, and in the near term, definitely, and in fact, in last 2 days, we have seen consumption stocks doing well. But in the long run, what are the key catalysts for consumption story? So if we talk about a decade or so, what are the main key catalysts that will drive consumption as a theme, especially as an investment opportunity in India?
So, great question, Niranjan. As always, overall, I would say that we've discussed a cyclical case for consumption, right?
Yeah.
In terms of it's coming from a weak base. Valuations are lower than 10-year average. Earnings seem to be bottoming out, and that's why it's a dark horse, and things are improving, and that's the reason even in our broader funds we are kind of gradually we have been increasing our weight in consumption. But India is a structural consumption story as well. And if you have to understand the structural consumption story of India, as you have rightfully put out, the slide that we have in front of us is the one to understand and internalize. Basically, the magic is around as we as the numbers change their spot from 2.4 to 4.2. Overall, from a period of over the next 10 years, as India's spend makes this transition, the characteristic of the spend of India is going to undergo a major change. And we are lucky to be participating in the same. But if you were to look at the drivers, the things that are making it happen, these are 6 that are enlisted in front of you. I'll briefly cover all of them in the interest of time, but it's not rocket science. First is demographic advantage. With average age of around 28 years, you and I both know that at 28, people generally just about enter the workforce. And that's the time they really spend on aspirational things overall. And that will certainly drive the consumption from roti, kapra, or makan related spend to more aspirational spend overall. The second point being rising income. Overall, we've seen Hindustan Unilever report earnings. They reported 0% volume growth. But on the other side, you have companies like Indian Hotels and Jubilant Foodworks, which sell pizzas, reporting high double-digit growth. That goes on to show how the consumption spend of India is changing and the positive aspects of the same. Third, urbanization. People are migrating from villages to tier 2 cities, from tier 2 cities to towns, and that's the reason the average size of the real estate owned, by an Indian has gone up, and I'm sure you, for anyone else, would vouch given the change that you have undergone over the last 1 year. Fourth is new age consumption. Now, I don't know anybody amongst the listeners who is in urban of India and has not used Blinkit, Zeptos, or the likes. In fact, this has the potential to change the urban consumption in a meaningful way and effectively take some bit of market share away from the traditional retail store. So an important driver for change, but at the same time will boost consumption overall because the number of choices available from quick commerce are meaningfully large. Easy credit availability. We covered in the previous slides, so won't cover detail, but net, easier access to credit is opening up a bigger market in terms of TV, fridge, consumer electronics, and all the areas where people are, to a certain extent, leveraging to kind of, get access to the goodies of life. And at a starting point of leverage, which is fairly low in India, this is certainly good news. Finally, premiumization. While there is a 6-month inventory for Maruti 800 or some of the mainstream cars, on the other hand, SUVs have a 6-month waiting period. That goes on to show that the premiumization is in full vogue. The point, Niranjan, that I am looking to make in this slide is these are the 6 drivers which will transform the spending, which is more oriented towards the basic needs, which is basically the roti, kapra, or makan sort of a situation, to more, what US spends like. So you have another slide, I'm sure you will bring it up, which shows where India is today and where US is today, and India will be in 10 years' time. I think while kind of, people can test their eyesight if they can read this slide, But I think the moot point here is that if you look at where India spends today, more than 50% of the spend is in food, beverage, or tobacco, automobile, and telecoms, which is basically the basic lifestyle changes, things that they spend on. But if you look at on the right-hand side, more than 50% of the spend is towards discretionary, towards basically areas, people where they have more cash flow than needed wherever they spend. This is the transition that India is going through in the name of consumption. And this is the change that we are hopefully looking to play in our portfolio through our different bets, along with the cyclical case of consumption.
Very well put, Trideep. And I think so. From timing perspective and all, it's quite important. But one of the things that people do have in their mind in terms of question is in a thematic fund. Does the results are quite cyclical, and I believe that is where our investment strategy comes into picture. And why don't you tell us about how the investment strategy has been designed to take care of the different opportunities that we have in consumption sector today in India?
So you put it very nicely, Niranjan. To put it more bluntly, you are saying all this English, all this thematic words is fine. How are you going to actually make it happen in the core case of a fund, right? So answer is right in front of you. Broadly, if you look at our consumption fund, it will have three pillars: core consumption, as you can see, emerging consumption, and cyclical consumption. Core consumption is basically the roti, kapra, or makan, the basic needs. I don't want to, this is by no means any stock picks, but Hindustan Unilever, ITC, Britannia, those kind of companies where they are exposed to, which is the core consumption part of any consumer, not just in India, but globally. This is increasingly a smaller portion of overall consumption spend, but yet a spend that is needed. This is where I said Hindustan Unilever reported a 0% volume growth. So we will have some exposure to the core consumption. But if you ask me what makes me excited about the fund is basically the other two categories, the emerging consumption and the cyclical consumption. In the emerging consumption, what we particularly want to capture are the impact of those 6 parameters and how they are changing consumption of India over the next 5 to 10 years. So it will have a more structural part to it. This would have QSR, this would have hotels, this would have quick commerce and all the jazzy areas, as long as they are good on valuations. And that's an important part where growth is strong, and I'm sure we'll create alpha for investors over a period of time. The third category is cyclical consumption. Now, beginning of this call, when we were talking about the outlook for the market, we said that starting with monsoons last year, rural side of the economy seems to be in a cyclically the right spot, where it is gradually kind of improving. Likewise, while urban consumption at the moment is going through a slowdown, driven by some of these budget changes, maybe in a year's time that could turn around. So these are the cyclical components of consumption and the economy, which we are looking to play as cyclical consumption in our fund. So basically, if you were to look at all of these three put together as 100, I would say roughly about 20-25% would be kind of, on the core consumption side, and about 80% would be on the emerging and cyclical consumption side. So the idea is not just a dull and boring roti, kapra, or makan defensive consumption fund, but a more vibrant, changing consumer habits, but a fund which reflects the changing consumer habits of India, and also to play the cyclicality in the context of consumer overall. When we think about this fund, we are thinking more in the flexi or multi-cap context, that overall, we'll probably, of course, we'll keep the leeway with ourselves, but about 40 to 60 stock portfolio. And the market cap composition would be broadly in the flexi or multi-cap kind of a spread between large, mid, and small overall. So Niranjan, thanks for being nice to me, but this is how we plan to kind of get the consumption habits of India reflected in the context of an equity fund, and hopefully, given where valuations are, given with the fact that overall broader markets have corrected anywhere between 10 to 15%, given that our starting point is we are talking about a sector which hasn't gone anywhere in the last 3 to 4 years, and hence valuations relative to their own 10-year history are quite favorable. We are confident that we'll be able to do a good job with investors' money in this fund.
Thanks, Trideep. Trideep, while we are discussing on the core strategy, I have a couple of questions that have come through, and I request participants, if you have any question, do send it to us so that we can answer them all at this point in time. One question is, you talked about sectors like consumption sector hasn't done well over the last 2-3 years. There's a question that even financials and financial services as a sector, especially banks, retail banks, haven't done well. So between consumption and financials, why do you think consumption would be a better play at this point in time between the two?
Right. So I think I must admit that financials is a super sector, so to speak, if I may use that term, rather than just a sector. It has, of course, 10 years ago, it used to be just a sector. Now it's a super sector of banks, insurance, asset management companies, wealth management companies, brokers, RTAs, and insurance companies. And I'm sure we have missed a couple of subsegments as well. So, today, when you say bullish on financials, yes, we are bullish on financials, but our segment of financials, which is NBFCs, as part of our broader market outlook. Then there are PSU financials. So, I think if I were to think about financials versus consumer, I would say that let's say for banks, the best of the times with best of the growth rates, best of NIMs, and lowest asset quality worries are behind us. From here on, it will be a cyclical kind of a upturn that will stand to come, where we'll have to be probably a little more selective with regards to the sector than before. So in many ways, the asking rate for financials is getting tougher. Whereas if you look at consumption, over the last 3 to 4 years, consumption has been weak because inflation has been high, interest rates have been high, and monsoons haven't been particularly great. So we are sitting on the base of fairly depressed earnings base. And plus, as I talked about, improving rural consumption. We talked about budget giving a bit of a 2 to 7% boost to rural to the earnings of consumption. There are catalysts which will make the earnings of the sector improve over a period of time. So as a combination of where valuations are, where earnings are, and what catalysts are lining up to be, it seems to me that consumption is certainly probably one of those sectors where I would say the ducks are lining up a few more than financials.
So, in terms of valuation, there's a question around valuation. Are valuation in the consumption space, closer to their long-term average, or at discount, or at a premium, but on a relative basis, they are still better? What is the case in terms of valuation?
So I think the confusion, there are two parts. Consumption stocks by nature are a little more expensive than broader market.
Okay.
And the reason why that is the case, because you have a preponderance of brands in this case, which is a store of long-term value, if you may call it that way. And hence, the valuations of consumption stocks need to be looked at in the context of their own history. And if you look at in the context of their own history, they certainly are 15-20% cheaper than the 10-year average. I mean, if you take the classic, and by this no means the stock recommendation, Hindustan Unilever, I remember the price during COVID times. The price used to be around about 2,000, 2,100. Today, after all the rise, it's about 2,500. So whereas markets have gone from, Nifty has gone from 7,000 to roughly 20,000 plus, 22,000 odd. So that tells you the extent of underperformance, and I'm just picking a random stock, one of the leaders in that segment. While earnings have moved, so clearly kind of earnings and relative performance are both in favor of consumer stocks today than what they were about 3-4 years ago.
Trideep, you talked about the themes and the catalyst, for consumption, but which are maybe top 5 sectors or rather subsectors within consumption that you would be positive at this point in time?
Let me sort of, bring at this point in time the last slide, which is the NFO dates. And I would say that if you look at the NFO dates, we are talking about 31st Jan to 14th of February. And basically, to answer this question, I would say that in and around Valentine's Day, watch this space. You will get to know our portfolio, which will tell you exactly what the subsectors within the consumption basket that we are overweight, and also the ones that we are underweight. But in the meantime, it'll be great to get the subscription in.
Right. So you just mentioned, a couple of sectors like demographic, retail, FMCG. So broadly, are these sectors where in pockets, of course, there are certain opportunities that you would be keen to look at in the
Yes.
consumption
So
space?
a straightjacketed answer would be that these are the spots that we would look to capture. The leeway that I would like to keep with myself is depending on which stocks at that point in time look cheaper, and versus their growth prospects, and act accordingly. So certainly we talked about the three components of the three pillars of consumption. One is the core consumption, where you could think about FMCG, versus maybe the weight in the index. We'll have to see whether we are overweight or underweight. But certainly in the emerging categories, we would have hotels, QSR, real estate. But the way to think about this is anything that is B2C is part of the investment universe. And within that, particularly the ones which cater to any or more of the themes that you see in here would be part of the portfolio. Certainly, these are some examples of subsectors where we would be positive on.
Another question is, you've talked about 14th Feb being the last date, and after that, the money will be deployed. There's a question that, some consumption names have already started running up. Do you think in next 15 days, a lot of that valuation gap or the opportunity would, you know, uh, get marginalized, and, the opportunity size will narrow down in next 15 days?
Well, I certainly don't know how the next 15 days are going to look like, but I know a few things. When we are describing the contours of this fund, we talked about the cyclical opportunity and we talked about the structural opportunity. If all goes as per plan, maybe some of the stocks go up a little bit over that time frame. But I am sure that as some of the drivers that we talked about populate down to earnings, it will be FY26 when we will start to see the results come through. And generally, my observation of my 25 years of history in markets are when earnings delivery starts to happen, then stocks generally tend to do better than what it earlier anticipated. So my sense is that it is very unlikely that all of that would be getting captured in the course of next 10-15 days. I would argue that this is also a time when market will digest the various different measures, not just by our own finance minister and Modi 3.0. That picture is clear, but maybe the Trump related factors are not yet clear. So I don't think I don't think the uncertainty in front of the markets are going to go anytime soon. But I would say this, that once we get the money post Valentine's Day, we wouldn't waste too much time in terms of deployment. And I want to have a very clear conversation around this. We think that by the end of February, latest, we would have the deployment done. And hopefully, kind of that gets us the best opportunity that we can. We are, of course, bound by, the way the whole process, and that takes a certain amount of time. We have to keep it open for a certain period of time for money to come in. But it's all in February, and hopefully, kind of, spring comes later.
Trideep, when we look at the macro, for consumption, as you just described in the budget, government has taken fiscal steps. There's a fiscal boost being given to consumption. We have RBI policy this week. Do you think there would be a monetary support as well? Will RBI take some step towards that? Will this lead to a double engine booster for a consumption theme? What's your expectation?
One of the learnings that I have of 25 years of history in stock markets is if you choose the starting point conservative enough, good things happen. If the starting point is fairly aggressive in terms of high valuations or earnings at its peak, then you're doomed to sort of fail. In many ways, when we called out consumption to be the dark horse of calendar year 25, we thought that the earnings and valuations are on our side, on the lower side. And hence, if at all there are any positive catalysts that come through, it will only aid rather than subtract. And hence, in that context, clearly the budget was in the shot in the arm. I would also say that if you look at the budget, one part which we haven't probably covered as much in detail, and thanks for bringing that out, is the course of fiscal consolidation. Given that we are targeting 4.4% of GDP, that means we have been fiscally fairly conservative in the way the fiscal policy has come about from the government. What that means is it has certainly opened the doors for RBI to loosen if they so choose. I'm sure RBI would consider, in conjunction with what's happening in the US and where they want to see the currency and stuff like that. But I'm hopeful that if not this time, at least in the next month or two, if you look at the entire year, we would see somewhere between 25 to 50 basis points cut in interest rates overall. And that will certainly boost the consumption in rate-sensitive sectors. So again, as we go towards the back half of this year, we would see that this will become a meaningful trigger for consumption as a sector, and hence the launch of the fund now, when earnings will flow in a year from now.
Great. Thanks, Trideep. I think so we have covered a lot of ground and many questions we've tried to answer. Before we close, any closing comments from you on the markets and this consumption theme?
I think the first thing that I would say is that this correction is different from what we have seen in the last 3 years. The difference is that last 3 years, the correction has been more very only macro-led, which had no earnings impact. This one has earnings impact. So in the way the markets will come back, it will also come back along with earnings coming back. So have a little patience and kind of, you have to let that earnings play out over a period of time, number one. And hence, from a broader deployment perspective, staggered way of getting into markets is a good way to approach this, rather than just looking at the 10-15% fall and expecting it to recover in short order. That's the second point that I would make in the way you go about deployment. The third point that I would make in favor of consumption is that we started off the year calling out consumption to be the dark horse. It has certainly gained momentum since we are talking about horses here post the budget. The final bit in terms of earnings hopefully will come about by second half of fiscal year 26, when earnings will also start to improve. So when things are lined up in the right direction, if we take a 3-year view with regards to the sectoral fund, a thematic fund that we are talking about, this is a good time to sort of consider the case for the consumption fund. And then all the best, and we'll touch base. I'm sure our sales guys will touch base post Valentine's Day to see if we have good news.
Thank you, Trideep, and thank you everyone for joining in. If you have any questions, do reach out to us, and thank you so much for spending time with us today and listening to views from Trideep. Thanks, Trideep.
Thanks. Bye-bye.